My name is Ron Lieber from the class of '93. I'm a little surprised to find myself up here introducing our designated griller today, Nick Zerbib. Nick was the guy who showed up at first floor at James with a collection of Def Leppard tapes and was the person whose parents were the very last to leave among our entire freshman class. It was the first child of theirs who had ever gone away from school, and they were sad. Somehow Nick grew up to be a finance pro, a steward of this very college. Nick sits on the board of trustees and on the investment committee. And it was amazing to watch him walking over here today, picking up the trash, greeting strangers. We all have a lot to be thankful for that Nick is here helping keep this place great and making it even better. I'm going to turn it over to Nick now to introduce our special guest. Thanks so much for being here. Nick Zerbib, class of '93.
Good morning. Thanks for joining us today. And by the way, I don't think I would have graduated without Ron. I think he spent all night my senior year rewriting my thesis. I don't know if I attributed the thesis to him, but I don't think I would have made it through. So it's great to be here with all of you in the class of '93. Just a bit of background on me. I graduated in '93. I was a history major. I began working in private equity about 25 years ago, and fortunate to be working with Letitia now on the investment committee of the board. And I just wanted to start, first of all, we have a tall order here, Letitia. We are the warm-up act for Sarah and President Elliott. So
yep. No pressure.
No pressure at all. But I'm going to introduce Letitia in one second. I wanted to read something that's pretty important as you think about the endowment and Amherst and universities and colleges that have the privilege of significant endowments. And this comes from the Bible of endowment theory. It's David Swenson's book, which is Pioneering Portfolio Management. He wrote, "Endowment support enhances operating independence and stability. Sizable reserves of permanent funds allow trustees to be less tolerant of government interference or unreasonable donor requirements. Large endowments enable administrators to smooth the impact of financial shocks, buffering operations against destructive external forces." So that's sort of the framework that I think we should think about the endowment. A couple comments on Letitia. We are incredibly lucky at Amherst to have Letitia at the helm. She joined us in 2019 from Cambridge. You'll hear a little more from her. We now have a world-class investment office, which suggests that before, I think it was a little bit different. There were a lot of order taking from the board and from the committee. We now have we're now institutionalizing that process under Letitia, which is, I think, going to put us in a really good position over the next 10, 20 years. And I just want to give you a sneak preview of Letitia. She recently presented at a Stone Point Capital event. That's the firm where I work. She was a panelist, and one of my colleagues had this really interesting observation. He said, "She's super smart, and she's fun." Go figure. So she's raising the profile of Amherst, and it's great to have her here. Let's get started with some questions. We're going to spend 30, 40 minutes with some questions, and then we'll open it up to Q&A for you all to ask Letitia and sort of inquire in terms of what's important to you. So a little bit of background, Letitia. Tell us how you got here. Tell us a little bit about where you went to school, what you studied. How did you join Amherst? What's the backstory?
All right. Thank you, Nick. Thank you for that introduction, and I want to say thank you all for being here. It's a real privilege to be part of the Amherst community, and I'm thrilled to spend this time with you today. And I would encourage I'm obviously going to get grilled, as you said, by Nick, and I would love some great Q&A at the end. So really excited to get started here. a bit on my background. So I had an international childhood. I was born in Singapore, lived in London, Tokyo. My family lived in Mumbai as well, which has had a fairly big impact in terms of how I think about endowments and sort of my life so far. Tokyo was really where I grew up, 7 to 14 years old, and it was an incredible upbringing full of sort of adventure and exploration. And then I went to Brown for undergrad, and as some of you may know, Brown, like Amherst, has an open curriculum. So I was a math major, but I took as many English classes as I did math classes and really sort of reveled in the liberal arts experience. And the flip side of that, of course, is that I came out of school with absolutely no skills and no understanding of what I wanted to do. So I spent a couple of years sort of bouncing around in kind of odd jobs, and then had the amazing fortune to land at Yale's Business School. And that is where I found endowments. Endowments are, as we see right here. This is the Bible, written by the longtime Yale endowment manager, and it was really in the air at the school there. There was a class that was taught by the team. There are many alumni from both the business school and the undergrad that go into endowments. And it really stuck for me. Endowments, first of all, there are a few things about endowments that I think are really appealing. There's the mission impact. You get to be in the field of finance and investing, but do it on behalf of a school. I'm really not sure there's really anything quite better than that. I love school, and to be able to do work on behalf of such an impactful mission is something that was very important to me. And then endowments it's an incredible perch to see a broad array of asset classes and investments. The opportunity set is incredibly wide, from venture capital to public equity investing, distressed, global orientation, US, Europe, China, just sort of the entire world. And I'm a real generalist at heart, so being able to kind of think about the world in that way was very appealing. And then investing also, and I would say endowments specifically, it's a very right brain, left brain field. So, and this is why I'm sort of practicing my pitch for we'll talk about this in a bit, but this is my pitch to the undergrad population. You get to, you do sort of, you need numeracy and the ability to analyze things, but it's also very much about people and kind of the human side of the world. So being able to do the right brain, left brain, it really stuck. And I will say that I found out about endowments by reading a Yale alumni magazine. So I'm just going to put a pitch in here for how great alumni magazines are. They were hugely influential in my life. And I was, so I graduated and I started working at Cambridge Associates, and we actually have some Cambridge Associates alums in the audience today, in addition to, of course, all these wonderful Amherst alums. And Cambridge is sort of the original, and continues to this day to be one of the main investment consultants to endowments and foundations. So I was there for 13 years and really got a master class in investing perpetual funds on behalf of endowments like Amherst. And then in 2019, I had the opportunity of a lifetime, which was to join this community and do what I'd always wanted to do.
Because I'm such a softie, let's do one more personal question, because that's my style. Who's influenced you and how, professionally, personally? I think it'll help set the stage in terms of how you think about being such an important steward of our endowment here.
Sure. Okay, I'd love to talk about, I'll talk about my family, my parents, and I'll also talk about, and it's not just because you're here, Nick, the investment committee. But sort of starting sort of in my early years, and obviously your family gives you so much, and my parents influenced me in many ways, but there are a couple of ways I think that are specifically, very specifically impactful in terms of investing in endowments. And one's from my dad and one's from my mom. And it's kind of funny looking back on this, but my dad taught us a lot about the trade-off between risk and return, which is kind of funny. I mean, this is an absolutely central premise, of course, to investing. And I can assure you that it was not around investing in our family when I was a kid. It was actually specifically related to sort of our life of being in these international places, not knowing the language, in cities we didn't know very well. And there can be a huge benefit to sort of being out there in the world, but it's not without risk. So we were sort of always talking about the trade-offs and having to understand the risk you're taking and what mitigants you can do to sort of reduce risk and still benefit from that kind of a life. And of course, I've carried that through to my investing days. And then my mom has given me a real love. She's a voracious reader, and she's given me a love and the habit of reading. And this is, this is probably you won't hear this a lot in investment talks, but I thought I would put a plug in right now for reading novels as being sort of the unsung hero of the investing world. Many people talk about reading and investing, but they rarely talk about novels. And I will say that I think it's actually a hugely helpful tool when you think about what you get out of novels, which I think is perspective and understanding people. And especially the sort of course, people is very, that I think is like quite obvious, but the perspective piece, there are two sides of every sort of transaction. And the ability to put yourself in the perspective of the person on the other side of you is extremely valuable. And this is what novels are all about. It teaches you empathy and the ability to think about what other humans are thinking about. So those have been a couple of very impactful things in my life. And then I did want to mention the investment committee. It feels both like almost no time and like forever since I started in 2019. In the long arc of life, it has only been 4 years that I've known this group, but they've just been the most amazing. They've provided incredible support to me as I've started at Amherst. And I joke now, I had this amazing experience at Cambridge Associates, tons of mentors, tons of wonderful committees and clients that I worked with. But I joke now that before I went into committee meetings, it would be like strapping on the body armor before you go into battle to defend what it is you believed. And that wasn't the case for all of them, but that was the case for many of them. And it was like crossing the chasm when I started at Amherst. And I felt it immediately. This is like a board of advisors. We are all partnered together with the investment team to try and solve this central issue of how do we invest these assets on behalf of the college. And that support and the perspective that they've given me, and that has been absolutely invaluable.
Let's move to the endowment a little bit. Just frame things for us. How big is it? How has it performed over a long period of time? Where is it invested? What's the process for investing?
What's the deal?
Yeah.
What's the deal with the endowment?
Let's demystify it.
Okay. So I'm going to start off just with a couple of they're a little bit more tedious facts, but just to make sure everybody's on the same page. If you read on our website, there's the Amherst College Endowment. That's $3.3 billion. It is invested along 3.3. It is invested alongside the Folger Endowment as well as other invested funds for a total of $4 billion in the long-term investment pool. So you'll see sometimes you'll see two different numbers, and I just wanted to clarify that so there's no confusion. The $3.3 billion endowment that's the pool of money that supports the annual budget. So we spend 4 to 5% from the endowment every year, and the idea is that our spending today is equivalent in sort of inflation-adjusted terms and in terms of overall support to the college as it was 20 years ago, and it will be equivalent 20 years from now. So our central problem that we are trying to solve is how do we invest these assets so that we can keep up with, in round numbers of 5% spending, let's say 3% inflation, and give ourselves a little buffer. So we need to earn high single-digit returns at least to sort of fulfill the core mission of the endowment. And if you look back historically, that's what Amherst has been able to achieve. 9 to 10% annualized returns on average over the last 20, 30 years. It's actually remarkably consistent if you look at the history. And that has been done with an enormous amount of work. It hasn't been easy. We don't expect it will be easy going forward. But that's sort of what the investment office is wholly focused on, and we work with the investment committee to do this. When you think about achieving those kinds of returns, and sorry, I will say one thing. So the spending off of the endowment today supports half the budget. It's actually closer to 60% of the budget. And that's been going up over time, and we'll sort of spend some time on that in a bit. When you think about achieving the sorts of returns that we need to achieve, the right answer is not, oh my gosh, we support half the budget, let's put this money in a mattress and protect it. We are highly reliant on the endowment, and we are highly reliant on the endowment to grow. So we need to invest it to keep up with what we want to do today as well as want to do going forward. And that essentially means, going back to sort of the risk-return discussion, it means taking some risk in the endowment. So when you kind of look through into at the securities level what we hold, 3/4 of the endowment is in equity or equity-like investments, and the balance is in cash, bonds, credit, a small real assets allocation. So it's primarily invested in equities. The other sort of central concept that's important to know is that we do not, and I'm sorry, I'm sure some of this is a repeat for some of you, but just to be clear, we at the investment office alongside Nick, we are not sitting there saying, let's buy Amazon stock. We do not pick stocks and bonds, we pick partners. So we invest, the sort of central activity that we do is we pick people to invest in, and we decide how much we're going to invest in them, when we're going to trim from them, how much we commit to new funds in the case of private managers. And there are a whole host of sort of reasons for this, but this is very common in the endowment world. Endowment offices are not staffed, nor do they have the governance or the scale to do the wide variety of investment opportunities that we pursue on a direct basis. We have to use partners. Amherst takes an approach where we think of it as a partner first, sort of a bottom-up approach. So we think we have the ability through the Amherst mission and the quality of the people we have around the table to access some of the top managers in the world. And we think through careful underwriting and a thoughtful decision-making process, we can pick some of the best managers in the world. So that's what we do. We have a concentrated portfolio of managers. It's less than 40 across the entire endowment. To be totally clear, when you look under the hood at the securities level, we have hundreds of different securities in the endowment. So it's a highly diversified pool. We are diversified across sector, we're diversified across geography, stage of investment, but we do have some concentration when it comes to partners. And the idea there is that we start with partners relatively early on, and as they do well and prove out, we concentrate capital in the most productive partners. So the shape of the portfolio is somewhat of a longer tail with half of the assets in our top 10 managers. And it's a very long-term focused approach. So it's concentrated partner first, and we are truly trying to find partners that we can partner with for decades. The average duration of our relationship is over 15 years, and for those top 10 managers, it's well over that. And this sort of, just to kind of sum it all up, the central premise is we are looking to partner with people and firms that we think have the opportunity to generate excellent returns for us over the next 10 to 20 years. And when you use that mindset, it eliminates a whole host of, it makes it very actually simple. It's not easy, but it's actually quite a simple thing that we are trying to do.
Thanks, Letitia. That's really helpful background. From my perspective, and obviously having been out of Amherst for 30 years, I was fortunate to be here last weekend for the graduation, and was struck by the diversity of the student body, which is fantastic. Obviously, there's enormous socioeconomic diversity today. There are international students who make up a very significant portion of the student body. How does the endowment advance the school's mission? Just connect that a little bit for us, because obviously we have a sizable endowment, and the college depends on that. But how are those two connected? Sure.
Okay. So I thought I would answer this question by sort of starting high level, sort of at a high level conceptual level, and then take it down to a story in terms of the endowment role and how it's evolved over the last 20 years. But just to stop for a moment on, at a high level, what is the endowment here for? I thought it would be helpful to put this in sort of business or financial and investment terms. When you think about the value of a company. As an investor, you're thinking about the stream of cash flows you're going to get out of that company from now and forever. That's a very sort of standard piece of analysis that people do in the way they think about valuing companies. And I actually think you can think about the endowment in that way as well. It supports spending this year, next year, and ad infinitum. And in this sense, and the spending goes to support the budget. As I said, it supports over half the budget. In this sense, the endowment, yes, it is a set of assets. It is an asset today, as a, it's this $3.3 billion asset that we have. But it really only matters to the school in that it produces spending forever. And that spending goes to support, by definition, the mission of the school. And what has happened over the last 20 years is that it increasingly supports the mission of the school in terms of its contribution to the budget. So there is really no daylight between the mission of Amherst and the mission of the endowment. It is only there as a tool to achieve that mission. And of course, I mean, there's some sort of leaps you have to make. The budget, we are assuming, of course, that the budget reflects more or less the mission of the school, and I think that you can make that leap, but that's kind of technically what is going on there. There's a very interesting story around how the endowment's contribution to the mission has changed over the last 20 years. And this is both in terms of just the overall support that it provides to the mission, but it has very directly impacted the mission in that one of the key aspects that the school has been focusing on for the last 20 years is equitable access to an Amherst education. So I'll just give you some numbers. Starting in 2000, the endowment was $1 billion, and the endowment support, you can basically, it's not exactly true, but you can basically just assume that spending off of the endowment is 5% every year. It varies between 4 and 5, but the rate that we spend off the endowment has not changed. What, of course, does change is the dollar values that come off of the endowment as the endowment grows or as the endowment grows over time. So in 2000, the endowment was $1 billion. Spending off of the endowment supported 30% of the budget, and tuition supported 60% of the budget. So just to sort of level set here, when I'm talking about, there's sort of the revenue side of the financial model. You have revenue that comes from endowment spending. You have net revenue that comes from tuition. So it's the revenue you get in from people who pay tuition, and then this is net of financial aid. And then there's other, which is essentially the annual fund and the Amherst fund and some other stuff. So I'm just going to focus on tuition and endowment as being the two largest components of the revenue stream. So in 2000, it was 30% endowment, 60% tuition. The board and the leadership of the school would have been having conversations around that time talking about how they want to have more, they do not want financial ability, they do not want ability to pay to be an impediment to getting an education at Amherst. If you had hit the button at that point and said, okay, we're going to be need blind right now and we're just going to do it, what that technically means is your tuition income is going to fall, and you can't actually do that unless you drastically cut the budget. So that is not what they chose to do. They chose to instead do this over time. And the way you're able to do it over time is if endowment growth can actually outpace budget growth. So if you think about sort of these lines, the budget is growing in the middle. As the endowment growth was disproportionate relative to budget growth, they were able to have tuition growth be lower. And what has happened over the last 23 years is it actually crossed over in 2010 from being majority tuition to majority endowment, and today endowment is 60% and tuition is 30%. So not only has the endowment spending just sort of by definition supported the mission, it has been an enabler of achieving this this focus in terms of allowing equitable access to an Amherst education.
That's super helpful. Helpful kind of long-term perspective on the endowment. So this raises another question which we often get. We have a very large endowment. It's roughly $1.6 million per student matriculant. So it's quite sizable. Should we be spending more of it? Some people say that Amherst is too dependent on its endowment for its budget at 60%. It's highly endowment draw dependent, and some people say that we should be spending less. Who's right? There's this crazy dichotomy. This is the most important question. You have to answer it for us.
Okay. Thank you for asking it. I do get asked it a lot. Okay, so is the endowment, I mean, the way I often hear it is, are we too reliant on the endowment? Should we spend more? Is the endowment too big? So the first, so my overall answer here is you sort of yes, 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 and. So yes, the endowment is very big. Our reliance on the endowment is extremely high. Just to make sort of a little bit of a joke here, but those two things are not unrelated. And basically, I think the right way to think about this is we have one of the highest, we have a very high endowment per student ratio. We have one of the highest, largest endowments in sort of in the liberal arts colleges realm. And we are for sure one of the most highly reliant on endowments in the entire higher education realm. We're in the top 5 consistently, and last year we were number 3. So this is serious stuff. The endowment plays a huge role in the financial model, and I would say it is an incredible position to be in. Everybody who is not where we are wants to be where we are, to be totally clear. So what do we do with that, though, is we need to just make sure that we are managing the risks that come with a highly reliant and very large endowment. And I promise I will get to the should we spend more piece, but I'm going to do that later. On the highly reliant piece, I would say that I think this brings up a really important point. So as I mentioned earlier, in order to generate the return, and we are highly reliant, and I will say this again, we are highly reliant on the endowment today, and we are highly reliant on the endowment to grow. So we take risk in the portfolio, and that means, and the last couple of years have been an absolutely magnificent example of this. There is volatility in the endowment. In order to generate the returns we need to accept some level of volatility in the endowment. And the endowment, of course, supports one of the least volatile things in the world, which is Amherst College. We don't want Amherst College to be volatile. That's not our goal. So we need to somehow design a program that allows the college to benefit from endowment growth over time without exporting the volatility of the endowment into the budget process. And the primary connection between these two entities is the spending policy and the spending rule. And I promise I will not go into detail on what that spending policy is. There's some math, and it can get sort of boring. The primary thing I would say is that it is a smoothed rule. So it helps us do this. It helps us incorporate endowment growth into the budget over time. And what this feels like is it feels like you underspend in good years and you overspend in bad years. And again, 2021 and 2022 were perfect examples of this. The endowment was up over 50% in 21. Endowment spending did not go up even nearly that amount. It went up in the 20s. And then in 2022, the endowment is down 10%. Spending off the endowment still went up in the teens as a percentage. So underspending good years, overspend in bad years. The other sort of note to make on having a highly reliant financial model on an endowment is you want to, on the margin, as your reliance goes up, you want to bring spending as a percentage marginally down so that you have more degrees of freedom in a difficult time, and you can sort of let your spend rate drift up. You don't, there's a rule, and we can have a conversation as a board and a leadership team about this, but you generally don't want to be spending more than 5% of your endowment. It's not sustainable. So there's a policy cap on 5% spending that we have at Amherst. So the lower we can be relative to that in a downturn, we can let the spending drift up without having to sort of cut budgets or keep budgets flat. So I think, yes, reliance is high, but it's a risk that we can, it's something we should be happy about, and it's a risk we can manage. On the should we spend more or less, what I can say to that is we spend 4 to 5% every year. Spending more than 5% is there's sort of no better way to put it. It's risky. What that sort of implies is that you think you're going to be able to do better than high single digits, and that's a very hard thing to do when you have such a reliant endowment model. Putting the endowment at risk like that in terms of decapping it over time is probably not something you want to do. We can't generate infinite returns. There is a limit to what we can do. And the endowment today is sort of fully leveraged when it comes to spending. We are spending as much as we think we reasonably and sustainably can. But this is an ongoing conversation, of course, with the board.
This is super, super important. This is one of the most important conversations, which is we continue to draw at that 4 to 5% level, which is the important guardrails to sustain it in perpetuity. And it is becoming a more and more important component of our spending at the school, which allows us to do all the incredible things that the school is doing. And it's a balancing act. So what you heard from Letitia very articulately is the most difficult balancing act that the institution is undertaking to make sure that the school and the endowment and the resources are spent intergenerationally in perpetuity. Yes, sir.
Yes, the 30 is tuition.
You have to watch how much of the endowment you use. The alternative is raise tuition or have more people pay as opposed to scholarships. Is that correct?
That's correct. That's correct. And that goes back to the school's mission to make the school more accessible. And so more of our students today than 20 years ago, 23 years ago, are getting financial assistance, and they graduate without loans. And so it is an access question and point.
I'm not saying it's easy, but...
No, that's right.
Yeah,
no, that's the trade-off.
Yep.
Yes.
You properly talked about the endowment meeting the needs of Amherst, and that's the right way to look at it, I think. Do you also benchmark your performance against other institutions? And if so, how do you figure out what the appropriate benchmark is, and how have you done?
Yes, we do. We benchmark ourselves in a number of different ways, and peer institutions is one of the key ones. It clearly matters to the school, it matters to us, and the short answer is we've done very, very well over the long term. Amherst has had outstanding performance relative to peers. But yes, it's something. There's a Cambridge Associates median, peer median, and of course we look at specific schools. You can think of one in particular. No, I'm just joking. We do that.
Do we provide any of the comparisons?
Yeah, in the annual report,
yeah,
we have the peer median. Yes,
yeah.
It's in there. Yep.
How is Amherst affected by there was an endowment tax imposed in the Trump Tax Act a few years ago. Is
Yes.
Amherst subject to it, and how is it affecting you?
Yes, we are subject to it, and it's quite small, but we are subject to it. Yes, it's not going to really. It's in the 10 basis points. Sorry. Oh my gosh! Now you're going to get me into tax. I have an amazing team member that helps me with this, but it tax gain. It's a capital gains tax for endowments that hit a certain threshold in terms of endowment per student, which we hit, and we do have to pay some capital gains tax.
Yeah. So yeah, if you're in excess of I think $500,000 per student of endowment, you're subject to a gain on realized gains. So it's also a function of how, we have a lot of long-term investments where we crystallize gains over a very long period of time. So it's not a meaningful drag on the returns, but it is incorporated in the net returns that you're seeing.
Yes. Yes.
Frank or Brenner? It's a race between the two of you.
Well, I have a mic. So, good luck, Frank. I have a question about about choosing managers. So individuals don't have your resources. We're going to fail. Managers we pick are not going to beat the market. You're 40 in your stable of, are they beating like an index fund? Are they beating the market? And if you are able to do that consistently, do you have any tips? Is there wisdom that you can share for individual investors?
I would say it's called Vanguard, and I highly recommend the S&P 500. For actually personal investors, I would say that.
You could charge Brenner, by the way.
Yeah,
maybe
and
there should be another
you
income
will owe me
stream.
after this, yes. So first of all, on the RR managers outperforming, I would say part of the reason that this is so hard, and this sort of gets back to sort of the ability to think long term. In order to do well in the investment markets, you need to be taking a position that is different from others. And there's really no telling when that position is going to be rewarded. And it can look great for a bit and then look poor. And the whole thing is there's a lot of noise in terms of, is this manager taking a good position or not? And what we spend a tremendous amount of time doing is focusing on the quality of the individuals, the shape of the firm that they have built. Are they building this firm so that it has the chance of lasting a long time and stitching into the culture a tremendous amount of alignment around high-quality decision-making and the ability to sort of manage through thick and through thin? Actually, a huge piece of what we think about is the people who are investing alongside us, because the ability to think long-term and hold a position that's not working for a long time, you can't do this alone. You can't do this just as a single manager. It really depends on the quality of the people that are investing in you. So that's just one piece. There's a lot of work that goes into it, but it's very hard. So the direct answer to your question is everybody. There's never a time when everybody is outperforming in the endowment, ever. There's always somebody who is not doing as well, and the central trick is trying to figure out, again, going back to sort of signal versus noise, what is going on at these managers? Is there something wrong, or is this just the noise of the market that is setting us sort of a false signal here? So yeah, am I answering your question? It's sort of a multifaceted approach, but I would say the thing that is not as obvious, and this gets back to sort of the right brain, left brain piece, is, yes, we do a lot of work on sort of the math of it all, analysis of track record, analysis of decision-making over time. That's a big piece of it. But I would say actually even more important are these qualitative aspects that allows really smart people with sort of a really long-term time frame to be able to actually consistently execute on that mission.
And I want to add one thing, Brenner, because that's a really important question. The most important function that the endowment office serves is selecting long-term relationships. We are seeking to make investments in largely illiquid strategies to be able to perform at the level that Letitia is describing. And when we analyze that performance, we look at the volatility over the long period of time, but we also look through the expenses, the cost of getting to that return. So that goes into that analysis, because Letitia said, you can invest in Vanguard, you can invest in an index fund and reduce all that cost, but an endowment has certain special attributes that allow it to, I think, invest in more illiquid assets over a long period of time, assuming you maintain the liquidity profile that we've maintained, to generate the returns that we need to achieve our mission. So it's a slightly different investment approach than what's available to a retail investor, to the point you made at the outset. Frank.
Hi, Frank Tan, class of 93. First of all, as one of 3 Amherst alums in the Yale School of Management class of 2000.
Oh, nice.
I'm going to sleep much better at night knowing that you're in charge. So thank you. A broader question for both of you, and as some of you from the class of 93 know, I've been asking Nick financial questions for 30 years now. Broader question about spending at the college. Obviously, we've talked a lot about the income side and how we are leveraging and using the endowment to help pay our bills. What pressures or considerations or discussions are there around the spending side, which I know is a sensitive topic in academic settings? Thank you.
Since you're on the revenue side, you want me to?
Yeah, sure, that's perfect, yeah.
Look, the spending side is arguably more controllable than the what we call the revenue side, which is 60+% endowment draw. And it's an area of focus. Higher education is subject to higher inflation. The last few years have been harder on everybody from an inflationary pressure perspective. Amherst is not immune to that. And Amherst is, I think, trying to be very thoughtful because it's super important for the school to continue on a path to provide access to the institution while not breaking or violating the guardrails that allow this endowment to support it in perpetuity. So that requires discipline on the expense side in order to continue to do what Letitia is describing in terms of 4 to 5% spend of the endowment to support what is an increasingly high percentage of the budget. So expenses are quite an important focus. It's hard to, in an institution like this, to change things quickly. And right now the backdrop is more complicated with the inflationary pressure that's impacting everybody. So, but it's an important topic, and thank you for asking. It's a really important thing that we talk about all the time.
Yeah.
They could get there on a real basis, not of inflation. But one of the upsides of what happened in 2022 is that 20-year expectations have gone up. Most of my colleges and universities are expecting a 6.25% real return. So if you're looking to marry that expectation with what you're, to exceed your spending, it's kind of a rosy picture right now, right? Or no? It may not be. Maybe your expectations didn't go up as a result of everything that happened in 2022.
Yeah, well, I would say, no, I think you're absolutely right. And of course, they would have been much lower in 2020. And this is actually a good excuse to sort of talk about return expectations and how they're kind of baked into the process, which is to say they are really not. They are sort of at a very, very high level. We are going to try and make spend plus inflation, and we think the way to achieve that is by investing in these terrific managers who are going to tend to invest in equities. Other than that, we are not sort of optimizing the portfolio for a specific return objective. And I think your question is sort of the feedback to the spending process. We think about through cycle investing in managers, and we think about through cycle investing from a sort of spending versus investing standpoint. So we're not trying to tinker it sort of year by year or even 5 year by 5 year. It's sort of a much longer range thing.
Which is one of the reasons that you didn't use today's inflationary numbers,
right?
Letitia, you used a long term.
That's right.
To your point.
Exactly.
It was 5 plus 3, not 5 plus 5 or 3 plus 5. So we're looking at it from a long-term perspective.
And I'll take the opportunity to put a little plug in for the sort of beauty of Amherst is it has a 30-year history in endowment investing, and these sorts of questions. I said 9 to 10% over 20 or 30 years. That is actually the case. If you go back and look at the 20-year and the 30-year, these are extremely long range. We have an extremely long-term perspective, both historically and looking forward, and there's an incredible power in that, and it allows us to have a through cycle view, both in terms of spending and investing, as well as in terms of manager selection.
Because the global financial crisis, I was here on that executive committee, and when we look at that denominator that you're looking at, that has not been 100% organic market growth. A lot of that has been the generosity.
Oh, absolutely.
Very loyal alumni base.
Yep.
And how much of that donation
Yep.
is making up for that growth that we've seen when we had that switch over
Yep.
from being tuition reliant to being able to rely on that?
I actually know the numbers. So because we recently did this for Betsy, who I think is here, and Advancement. And actually, this gives me an excuse to talk about the other. And I talked about endowment growth being a big driver, yes, of this ability to go from 30-60 to 60-30. Endowment growth is a function of three things. It is a function of investment returns, gifts, and disciplined spending. And when you look at peer schools, we've been able to do well on all three, and it's been a huge driver of the success of the endowment and the financial model shift over time. On spending, on gifts specifically, I think we did the analysis back to 1992. I'm actually forgetting exactly when, but it was $500 million of endowment gifts. When you incorporate not only the gifts, but the return that those gifts earned, which is the right way to think about it, it doubled the impact to $1 billion. So the endowment would be $1 billion smaller if it hadn't been for endowment gifts, because the gifts grow in the endowment. So yes, it's a huge, thank you, Leroy, for that question. It is a huge piece of the success of the endowment over time.
Just a couple more questions. Do we have until 15 or? Yeah, please.
Thank you. I don't know if is this on? Thank you. It's been very interesting. Of the 4 to 6% annual spend, does that include the spend on the physical structures on this campus? Since I was a student, it's impressive and awesome to think about how much has been put into the facilities since I was at school. And is that part of that 4% or 6% take?
4 to 5%.
Right, sorry.
The answer is basically no. So this spending is the spending to support the budget. The physical plan is primarily, and I see Mike Thomas, our new CFAO, in the house. This is for the physical plan is primarily debt funded. The endowment is an important piece of how we have the rating that we have and sort of the liquidity management with respect to the...
How much debt does the college have?
Roughly 600 million. 600 million of debt. But think about from the standpoint that capital planning usually draws on incremental debt or gifting, and the operating budget, which is where we use the 4 to 5% to support the operating budget, is maintenance. Right. So CapEx would be separate. Right. Okay. Maintenance, of those operations, so ordinary course maintenance would be coming out of the operating budget. So that would be used for that.
Yes, and sorry, gifts.
Yes.
Yeah, hi, class 2013 here. I had a question about, thank you, a question about the topic of spending more out of the endowment. Back to that just for a sec, because I understand the percentage limit, 4 to 5, spending out of the endowment every year, and then aiming for a growth of high single digits percentage every year. But percentages being not the same as raw numbers. With endowment of $3.3 billion, is there a point, I guess, is there a point at which you just spend out of the endowment because you hit the dollar amount you want in there for a given time period? Like, hey, we hit $3.5 billion for the next 5 years. That's what we wanted, so the rest we're just going to spend. Is that something that ever happens or anything in that realm of decision making, if that makes sense?
Sorry, I didn't totally follow.
I'm talking a bit fast, sorry.
If it's, sorry.
I understand the percentage limits
Yep.
on how much you spend out of the endowment, but is there, switching from percentage to a actual dollar amount consideration, is there a goal for how many dollars you want in the endowment, after which you might spend more?
Oh, how many dollars do you want the endowment to be?
Exactly.
Yeah.
Like if you have a goal of $3.5 billion in the endowment for 5 years and you hit it early in that 5 years, do you spend more for the rest of that 5-year period? Is that making sense?
Yeah.
Let me try to answer the question. I think what Letitia described is all the different constraints, and there are many, in terms of the budget's dependence on the endowment and not breaking that 4 to 5% draw. I think maybe what you're asking is what we would call, when do you hit terminal velocity? At what size does the endowment have to be such that the school doesn't need to charge tuition to anybody? It's just, you know, and that's when you multiply the endowment times 5%, and that should cover 100% of the cost of per student. Now remember that even the individuals who pay full tuition at this institution are getting a very large subsidy from the endowment. So it's a tall order. You have to be at 2 or 3 times the level of endowment per student for us to reach the point of terminal velocity. So it's that's the way I would answer it.
Yeah, and the other maybe the other point to make is that the spending that we are, the budget that we are supporting 60% of, these are not one-time costs, they're recurring costs. So you can't just think about supporting the budget today. You can't just say, oh, we're going to add $5 million to the budget because we have a $3.3 billion endowment. What kind of a big deal is that? You have to think about that, the fact that that $5 million of extra spending will have to be supported in perpetuity. So that is the big difference there. So when you're thinking about doing extra spending, you can't just think 1 year at a time. And when you think in perpetuity, you have to go back to this concept of, well, what rate can I support? So you're right. I mean, you do need to think about dollars and percents when you think about endowments, but when it comes to ongoing support of what is a perpetual sort of budget machine, you've got to think about it in that way.
Letitia, thank you. We'll do some sidebars, but thank you so much for this discussion, and thank you for everything you do for the college, really.
Thank you. Thank you for having me.